With the week nearing its end, we note that the US preliminary University of Michigan consumer sentiment has yet to be released on a monetary level. We note the release of RBA's September meeting minutes on Tuesday, BOC's September meeting deliberations, and we highlight the Fed's interest rate decision on Wednesday. SMB's, Riksbank's, Norges Bank's, BOE's, and from Turkey CBT's interest rate decisions are all due out on Thursday. And lastly, BOJ's interest rate decision is coming on Friday. In regards to financial releases, we make a start on Tuesday with Eurozone's final HICP rate and Canada CPI rates both for the month of August. On Wednesday, we make a start with Japan's trade data, followed by UK CPI data, both being also for August. On Thursday, we note New Zealand's GDP rate for Q2, France's overall business climate figure for September, the US weekly initial jobless claims figure, the US Philly Fed Business Index for September, and Eurozone's preliminary consumer confidence figure for the same month. Lastly, on Friday, we begin with Australia's preliminary Judo Bank Manufacturing PMI figure for September, Japan's CPI rates for August, and the preliminary Jabun Bank Manufacturing PMI figure for September, followed by UK's retail sales growth rate for August, France's, Germany's, the Eurozone's, UK's, and the US preliminary S&P PMI figures for September, as well as UK CPI trends figure also for the same month, while we end with Canada's retail sales growth rate for July. The US dollar is about to end the week in the greens against its counterparts for a 9th consecutive week. On a fundamental level, we highlight that the House of Representatives have opened a formal impeachment inquiry into President Joe Biden, and given that the government's funding expires on the 30th of September, and as such, any delays may increase the risk of a government shutdown, could weigh on the dollar. On a monetary level, we highlight the Fed's interest rate decision. The bank is widely expected to remain on hold, given that Fed funds futures imply a probability of 97% for such a scenario to materialize. Yet, the fact that both the CPI and PPI rates accelerated shows the persistence of inflationary pressures in the US economy and may force the bank's hand for another rate hike. Even should the bank remain on hold, a possible hawkish accompanying statement or a hawkish tone in Fed Chairman Powell's press conference could provide some support for the US dollar. On the other hand, should the bank remain on hold and signal that it has reached its terminal rate, we may see the US dollar losing ground. The pound seems about to end the week weaker against the US dollar and relatively unchanged against the euro and JPY. On a fundamental level, we note that the issue of Chinese espionage in the UK may create tensions in the Sino-UK relationships and thus weigh on the pound. On a monetary level, we had the speech by BOE policymakers Mann and Pill in the past few days, where they displayed the preference for further monetary policy tightening. The scenario of another rate hike is also widely expected by market participants, and as such could provide support for the pound, a view with which we agree, as the current levels of inflation are still far higher than the bank's 2% target. On a macroeconomic level, we note the UK GDP rates, which came in lower than expected at minus 0.5% month-on-month, implying a contraction in the UK economy and could weigh on the pound as the UK's economic situation continues to deteriorate. Lastly, we note the financial release system from the UK next week with the UK CPI rates, retail sales rate for August, the UK's preliminary manufacturing PMI figures, and CBI trend orders figure, both for the month of September. JPY is about to end the week relatively weak against the dollar, yet remained unchanged against the euro and the pound. On a fundamental level, we note the Japanese Prime Minister has reshuffled his cabinet, with some new appointees appearing to notion that Japan is intent on strengthening relations with Taiwan, which could provoke China, thus generating instability in the region, which may support JPY as it may experience safe haven inflows. On a monetary level, we note the speech from BOJ Governor Ueda that was deemed to be hawkish and forecasted a switch of monetary policy direction, yet we believe that it is not the case at this point and may occur during next year. Therefore, despite the JPY gaining upon the comments of the governor, we anticipate a clearer picture may be pinned in the bank's interest rate decision, which is due out next Friday. There is widely anticipated that the bank will remain on hold. However, should there be an indication of a shift from the bank's current ultra-loose monetary policy standings in their accompanying statement or press conference, we may see asymmetric support for the JPY and vice versa. The euro is about to end the week in the reds against the US dollar, yet relatively unchanged against the pound and the JPY. On a fundamental level, we note the statements made by the EU Commission President Ursula von der Leyen, who stated that China was providing huge subsidies to its EV makers and launched an anti-subsidy investigation against Chinese imports, which could spark retaliatory measures by China. And given its status as a major EU trading partner, any tit-for-tat measures could weigh on the euro. On the monetary front, we note the decision by the ECB to raise interest rates by 25 basis points, yet the euro weakened on the release of the interest rate decision, as the bank implied that it has reached its terminal rate. In addition to that, in ECB President Lagarde's press conference, she stated that the risks of economic growth are tilted to the downside, implying that the bank may be concerned about the possibility of sluggish growth and may we add the possibility of a recession in the zone. Overall, the change of stance of the ECB and the worries for a possible recession in the Eurozone may weigh on the common currency. On a macroeconomic level, we plan to closely watch the release of September's preliminary PMI figures, especially for Germany's manufacturing sector, and any adverse data may enhance market worries and push the euro lower. AUD is about to end the week higher than the US dollar. On a fundamental level, we note that LNG workers at the Chevron plants are reported to be escalating the industrial action, with the possibility of 24-hour strikes occurring, which could further intensify supply chain fears for LNG in Europe, but also weigh on the Aussie. On another fundamental note, we continue to monitor China's substantial attempts at boosting economic growth, and should there be an indication of further improvement, as was the industrial output growth rate for August, it could also support the AUD. On a monetary level, we note that RBA's September meeting minutes are due to be released next Tuesday. Should the meeting minutes indicate that the bank is unwilling to hike interest rates in the future, we may see the Aussie weakening and vice versa. On a macroeconomic level, we note Australia's employment data, which was released on Thursday, and we correctly anticipated in the last week's report that it would come in higher and appears to have provided support for the Aussie, as the data was indicative of a resilient labor market. As such, should next week's preliminary Judo Bank manufacturing PMI figure coming higher than expected, we may see the Aussie gaining some ground. The loonie is on track to finish higher than the greenback, ending an 8-week losing streak. On a fundamental level, we note that the country's ruling Liberal Party under current Prime Minister Trudeau are trailing behind their conservative opponents based on recent polling. In the event that the country's current ruling coalition collapses before 2025, we may see the political uncertainty weighing on the loonie, yet at this point in time, this scenario is considered unlikely. On another fundamental note, CAD traders may be keeping a close eye on oil prices, which are about to end higher than last week, and as such could support the loonie given Canada's status as a major oil-producing nation. On a monetary level, we note that the Bank of Canada is due to release the September monetary policy deliberations on Wednesday. Should the document be characterized by a dovish tone, it may be perceived as another signal that the bank has reached its terminal rate and thus weakened the CAD, and vice versa. On a macroeconomic level, we highlight the release of Canada's August CPI rates and July's retail sales, and the possible acceleration may provide some support for the CAD, as it would imply a more resilient demand side for the Canadian economy and a more persistent inflationary pressure. In the coming week, we expect volatility in the FX market to continue to increase, given the high volume of monetary policy decisions that are due out next week. We also note that in the equities markets, Arm Limited went public yesterday with substantial success, while US stock markets seem about to end the week higher due to the improved market sentiment. As for gold's price, we note that it appears to be continuing its downward descent for a second week in a row. Lastly, we note that the tensions between the EU and China seem to be increasing, following the announcement by the EU Commission that China has been allegedly heavily subsidizing its domestic EV market, which may promote unfair competition in the EV market as EU car manufacturers struggle to compete with their Chinese counterparts' lower prices. It's characteristic also that in the US Congress, Members are reported calling the Biden administration for harder measures against China, and the overall issue could have an adverse effect on market sentiment should tensions escalate further. We hope that you found this report useful, and from all of us here at IronFX, best wishes for solid trading.
So today's session, as I mentioned earlier, is about trend trading. So as per usual, just a disclaimer before we get started. A risk warning: our products are traded on margin and carry a high level of risk, and it is possible to lose all of your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Disclaimer: the information in this webinar should not be considered investment advice and/or an investment recommendation, but instead educational material only. This material is just the personal opinion of the authors, and the client's investment objectives and risk tolerance have not been considered. So IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I will be your speaker for today. I'm an investment analyst from the company Everest Fortune Group, who were finalists for Best FX Research and Best Equity Research in the years 2019, 2020, and 2021. So here's our agenda for today. We have quite a number of slides to get through. So if you have any questions throughout the webinar, feel free to pop them into the chat or in the Q&A session, and I'll be happy to answer any questions you have. So this is our agenda for today. Firstly, we'll go through what exactly is trend trading and how to identify a trend using trend lines and channels. And then we will look at the different indicators that you can use and how you trade using these indicators. Next, we'll look at a couple of disadvantages of trend trading and how you can overcome these disadvantages. Okay, let's get right into it. So what exactly is trend trading? So it's a popular strategy used in Forex markets by traders to take advantage of the directional movement of currency prices over time. So as a beginner, understanding trend trading can help you to make more informed trading decisions. So trend trading is based on the idea that currency pairs tend to move in certain directions for extended periods of time before reversing. These movements can be upwards, referred to as an uptrend, or downward, which would then be referred to as a downtrend. So the goal of trend trading is to identify and capitalize on these sustained price movements. So statistically, a trend is more likely to continue than to reverse, and that's why a trend is assumed to be in effect until it gives a clear signal that it has reversed. Hence the sayings, the trend is your friend and you should never go against the trend. But of course, there are a couple of exceptions to this, so we'll talk a bit about those later on in the webinar. But the general rule is that when you follow these trends over different time frames and stay away from markets when they are not trending, then traders can then increase your profits by making these opportunities. So how exactly does it work? Excuse me. So here's just a simplified breakdown of how trend trading works and a couple of steps that you can take. So firstly would be identifying trends. So this would be an uptrend would be higher highs, and then a downtrend would then be lower lows. So this is typically done by analyzing historical price charts. Next would be your entry points. So once you've identified the trend, the next step is to find an opportune entry point. So over here, I've given an example of an uptrend. So during an uptrend, you might want to look to enter a trade, and when the price has retraced slightly from its recent high. So this suggests that the trend will then continue. Alternatively, in a downtrend, you might look for a retracement before the price continues in its downward movement. Thirdly, we have setting stop loss and take profit levels. So to manage risk, it's crucial to set stop loss and take profit levels. So SL is stop loss, TP is take profit. Just to be sure. Okay, so a stop loss is a predetermined price at which your trade will automatically close and limit potential losses if the market moves against you. So this is also a risk management technique that we'll talk a little bit later. Next, a take profit level is where you decide to exit the trade to lock in your profits before the trade potentially reverses. Next, for number 4, we have riding the trend. So once you're in the trade, you have your risk management levels, so your stop loss, your take profit levels, all accounted for. Then, and your trend continues, then you can aim to stay in the trade as long as the trend remains intact. So this involves monitoring the price movement and adjusting your stop loss and take profit levels if needed. Number 5, exit the trade. So eventually you can expect the trend to reverse or weaken. So at this point, you might decide to exit the trade and take your profits because it's important to note that trends will not last forever. So it's important to observe your trades and be vigilant and not get too greedy. Lastly, practice and analysis. So this is pretty self-explanatory. Like any trading strategy, trend trading requires practice and analysis. So you want to keep refining your skills by studying the charts and learning from your successful and unsuccessful trades. And of course, keeping updated on market news and events that could impact currency prices. Okay, so we talked a little bit about setting stop loss and take profit levels. So I just want to dive into that a little bit. So firstly, we have a retracement, which is what we talked about in the previous slide. So let's start off with pullback support and resistance. So pullback support is a strong level of support and it breaks out from a previous resistance level. Now price is dropping back to visit it again. So a tip is that when a pullback support lines up with a Fibonacci level, it's typically considered to be very powerful. Here we're talking a little bit about Fibonacci levels, but if you're a bit confused about those, not to worry, we have an entire Fibonacci series on the different types of Fibonacci's. So you can go ahead and take a look at those. But the point that I'm trying to drive here is basically the introduction of a pullback support and resistance for your that could be used as your entry and exit levels. So pullback resistance works well when it breaks a significant low, as you can see from the chart here. So it breaks the level and then it makes a significant swing low and then it starts to pull back to this level. So that's why we call it a pullback. So we advise that it's even better if there are multiple Fibonacci levels that are lining up with it. So here's an example of a pullback support. Here we have 3 swing highs that line up in the same area. So remember that these are typically areas, not so much levels. So we have 3 areas that line up and price has passed through this level and it looks like it's made a swing high and it's coming back down to bounce off of this level. Excuse me. So here we have, we're expecting price to bounce off of this level, and that's why we call it a pullback, because we're expecting price to pull back to this level. So this green area here is now considered a pullback support level. Okay. Next, let's take a look at the pullback resistance example. In this example, we have 3 swing lows that line up in the same area, as you can see from this green area here. So the green area is our support, but once price breaks out of this support level, and we are expecting it to reverse off of it, then you can call it a resistance, a pullback resistance. Okay, so as you can see from the arrows, we're expecting price to pull back to this level here. So here's another example, but over here we have a actual example screenshot from a chart. So we have a swing low here and price is moving up. It's made a reversal over here. That's another way that you can identify trend reversals by looking at the swings. But we'll get into those in a little bit. So we have a swing high here, swing high reversal, it's going down, and then it surpassed the swing low support, and that's why we are expecting it to reverse back to the support level. But now that it's surpassed this level, it's now a resistance. So it is a pullback resistance in this case. Okay, next we have another pullback resistance example here. Actually, this is a follow-up from the previous slide. So this is the previous slide. We're expecting price to reverse off, and that's exactly what it did. So it reversed off of this swing low, reversed off, and it hit it right back to our pullback resistance, just as we expected. But what happens when price reverses off of this pullback resistance? So that's what we call a overlap support or resistance. So this overlap support and resistance basically occurs when price reacts off of a particular level from the top and from the bottom. So basically it means that when a swing low, as you can see from the GIF, lines up nicely with a swing high, then that's what we call an overlap level. So the more times that it reacts off of this level, the stronger the overlap area. This means that there are bulls and bears that are respecting this area, and that's why it's so important to take note of these areas. Okay, another pro tip, so if the overlap area lines up with other elements such as Fibonacci or graphical elements, it will make it even stronger. Okay, so here's an example of an overlap support or resistance. So it's basically a pullback support or resistance, just that price has actually reversed off of the level. Okay, so swing low support becomes a pullback resistance, as you can see from this screenshot. Once it breaks the support at this 105.643 level. So here in this GIF, you can see how price retraced back to this level or pulled back to that level, and then it proceeded to reverse off of that level. So once the reversal occurs, then it is an overlap resistance. Okay, let me know if there are any questions so far, but I hope this is pretty straightforward. Oops, sorry about that. Press the wrong button. Okay, next slide. So now we're looking at a combination of the pullback and overlap levels. So here we have a big swing high resistance level, as you can see here at the first red arrow. And then it becomes a pullback support where we expect price to pull back or retrace this level once it has passed that swing high resistance. So it passes it, and then we're expecting it to come back to it. And that's why it is now a pullback support. Once price actually touches that pullback support and it reverses off of it or it bounces off of it, then we can call it an overlap support instead. Okay, you can take a look here for a while and let me know if there are any questions so far. But we do have a couple more examples in case you are confused. Okay, let's move on. So here's another example. We have multiple swing high resistance. You can see from the purple circles here, one swing high here and one swing high here. Next, at point number 2, I have an arrow indicated here. That's where price surpasses the resistance. So price surpasses the resistance, and then we call it a pullback support. So you can see how the resistance then changes to a support level once price surpasses it. So we are expecting price to pull back, and it did. So point number 3, price has pulled back to our support and has in fact bounced off of it twice. So at the blue circles, you have 2 swing lows that line up nicely with these 2 swing highs originally. Once price has bounced off of this level, the 0.68745, then you can call it an overlap support. Okay. Okay, our last example before we get into how we can identify a trend. So our last example, pullback and overlap. Here we have multiple swing low supports, 1, 2 here, and then price has pulled back, or rather it has surpassed our support level, multiple swing low support. So it surpassed it, and we are expecting it to reverse back. We're expecting to reverse back because we have observed this swing low. Okay, so we observe the swing low, we see price approaching it, and we're expecting price to reverse off of it. And you can see that's exactly what happened. We have 1, 2, 3 swing highs that line up nicely, and they're all making it an overlap resistance instead. So we see price then break out of this overlap resistance one more time. In this case, since it was a resistance here, once it breaks out of that resistance, it's now a support level. And as usual, we're expecting it to pull back, which is why point number 4, it's a pullback support. And lastly, point number 5, price has pulled back to our support and reversed off of it, making it an overlap support. So you can see the swing low here, reversing right at the exact same 33420 support level. Okay, any questions so far? Okay, okay, no questions. Let's move on to our next part of the webinar. How do you identify a trend? So this brings us to our next point, which is identifying trend lines as well as trend channels. So these can really help you to identify a trend. But how you identify a trend is pretty straightforward. Just by looking at a chart, I'm sure you can tell whether price is moving up or down. And it's also important to note that you should be looking at the different time frames for the specific asset that you are looking at, and not just at the time frame that you are analyzing. So it's important to get an overall view of the direction of where prices are headed towards. So upwards, downwards, or ranging. Okay, so let's get into how we can draw valid ascending trend lines. So ascending trend lines should be drawn from the bottom and not from the top. So here we have an example. And trend lines should also have at least 3 significant touches in order to be considered valid. Because 2 touches tend to be more coincidental, and that's why we go for at least 3. Okay, here's a couple of examples to show you how significant exactly these swing lows should be. So I have one really big swing low here and one swing low here. So that's how clear your charts should be when you are analyzing for trend lines and trend channels. Here we have another example, 3 trend lines, or rather 3 points touching the trend line. Actually, we have another small point here. And now for descending trend lines. So same thing, a descending trend line should have at least 3 significant touches as well. But for descending trend line, the lines should be drawn from the top and not from the bottom. Okay, here's an example. Here we have really nice 4 swing highs that touch our trend line. Okay, once again, take note of how clear the price movement should be. Yeah, you want to look for something with really clear movement in price. You can see exactly where the peaks are and the troughs are. Here's another example of a descending trend line. So you want to watch out for at least 3 significant touches in order for it to be considered a valid trend line. And here you see price playing the reaction off of the 4th touch. So it is breaking out of the 4th touch, 4th swing high on this trend line. Okay, so here we have a little activity. Let me know in the chat or in the Q&A session if you think this trend line is valid or not. In this case, of course, we can all agree that price is moving downwards. So we are expecting to draw a descending trend line. So let me know if you think this trend line is valid or not. Okay, so this trend line is not valid because remember, for descending trend lines, we want to make sure that we draw the line on top of the charts. Okay, next, let's take a look at drawing valid channels. So channels typically require at least 4 significant touches to be considered valid. You need 2 at the top and 2 at the bottom. But they don't have to be in consecutive order like what we see in the picture here. Okay, so here are some examples. We have a descending trend channel here. Remember, 2 touches on top, 2 touches below. And once again, take note of how clear the charts, or rather how clear the price movements should be. Here we have an ascending trend channel. So of course, it doesn't have to be in consecutive order as we mentioned earlier. Doesn't have to be in consecutive order. You can have some price movement in the middle, but as long as there are 2 touches on top and 2 below, then it's considered a valid trend channel. So these are just some graphical tools that you can use when you're trying to identify a trend. And this is typically the first step whenever we want to analyze a chart. So if we have time after the slides, I'll go through maybe one setup. I think we only have time for 1 or 2 setups. So but I'll definitely go through the different steps that you can take to identify a trend and how exactly you can use that in your trading strategy. Okay. Next, we have the different indicators that you can use to identify the trend. So we're going to be talking about the different indicators that you guys can use, but let me know in the chat what are your favorite indicators to use. Yeah, just curious to know how many of you guys actually use some of these trend indicators. Firstly, we have the Ichimoku cloud. So I'll just briefly go through how exactly you can use the Ichimoku indicator. But I wanted to mention that this is not a webinar for Ichimoku strategies. So we have another webinar that is solely about how we can use Ichimoku, not just the cloud, but the different lines involved as well that I'm going to talk about in the next few slides. So you can go ahead and take a look at that webinar instead. But for this webinar, I'll just be breaking down the different lines and giving you a summary of how exactly you can use it. Okay, so the Ichimoku Kinko Hyo is a technical analysis tool that's used in Forex trading. So it consists of several elements, several components, including the Tenkan-sen, the Kijun-sen, Senko span A and B, and the Chikou span. Okay, I hope I'm pronouncing those right. But basically, these lines include a 9-period average, 26-period average, average of these two averages, 52-period average, and a lagging closing price line. So the cloud is a key part of the indicator. And how people use Ichimoku for trading is basically 1, to identify trends, 2, as support and resistance, and 3, confirmation, as well as buy and sell signals. So if we're just looking at the cloud only, which is the most, I guess is the fastest way, because you just look at it at one glance, it tells you exactly what the indicator signals are. So over here, I'm telling you guys that when price is below the cloud, then the trend is downwards, or it's suggesting a downward trend. When the price is above the cloud, then the trend is typically upwards. Trend signals are strengthened if the cloud is moving in the same direction as the price. So for example, during an uptrend, the top of the cloud will be moving up, or during a downtrend, then the bottom of the cloud will be moving down. So the top of the cloud, the bottom of the cloud, these both have names as well. So you can see over here. So we have the Tenkan-sen, which is the conversion line, which is the average of the highest high and the lowest low over 9 periods. The Kijun-sen, or the standard line or baseline, is the average of the highest high and the lowest low over the past 26 periods. Chikou span, which is the lagging span, is the current closing price plotted 26 periods behind the current time. So these are pretty technical meanings of what the lines mean. So, but we typically will only look at the cloud. It depends on your own trading strategy. Okay, next we have explaining the lines. Oh, I didn't talk about the Senko span. Okay, so Senko span A, or the leading span A, is the average of the conversion line and the baseline plotted 26 periods ahead of the current time. And that is a leading indicator of the trend. For Senko span B, D is the average of the highest and the lowest low of the past 52 periods plotted 26 periods ahead of the current time and used as a leading indicator as well. Okay, Next, we have explaining the lines and identifying trends. So here we get into what each of the lines, or rather how you can use each of these lines. So the first way is to use Ichimoku to identify trends, which the Tenkan-sen and the Kijun-sen can help you with. So a bullish trend occurs when the Tenkan-sen is above the Kijun-sen. So Tenkan-sen is the conversion line and the Kijun-sen is the baseline. Yes, correct. Okay, so over here in the chart that I've included, the Tenkan-sen is the blue line or conversion line, and the Kijun-sen is the red line or the baseline. So bullish trend occurs when the blue line crosses above the red line. And then a bearish trend occurs when the blue line crosses below the red line. Okay, next, the second way is for support and resistance. So this is just extra. So the first way was to identify the trends. Now the second way is to identify potential support and resistance levels. So the Senko span A and B, which I mentioned earlier, are the leading indicators. These can determine support and resistance levels. So if the price is above Senko span A and B, then it's considered to be a bullish market. So in this case, Senko span A and B, as you can see in the screenshot that I took from TradingView, you can see that these outline the clouds. So it's basically used as the same way as I mentioned earlier. When price moves above the cloud, it's bullish. When price moves below the cloud, then it's considered bearish. So same thing, if price moves below Senko span A and B, it's considered a bearish market. And these lines can also act as resistance levels, since they are specific levels, as you can see here. Okay, so second use of Ichimoku, first use was to identify trends, and second use is as support and resistance. Okay, thirdly is for confirmation. So the Chikou span is used to confirm the signals that's generated by the Tenkan-sen, Kijun-sen, and Senko span. So the Chikou span is the lagging indicator here. And you can see I've shown you guys what it looks like on TradingView. So it confirms if it's above the current price, then it confirms a bullish trend. And if the blue line is below the price, then it is a bearish trend. So we just use this for confirmation of the trend.